Good evening, and I'd like to welcome everyone to our seminar today on investment basics. My name is Stan Lozinski of Comprehensive Financial, and I will be moderating this presentation for you. Part of the presentation will focus on discussing some of the basics of investment planning, as well as discussing some of the fundamental investment concepts, providing you, again, some guidance on your needs and goals and whatnot towards retirement or just in general long-term investment savings. Our goal here is to give you a good general overview of all the various options that are available to someone out in the marketplace, and again, guide you down the path of what's going to be appropriate for you as an individual investor. So I'm going to start here. I'm going to share my screen and proceed with the seminar. So again, just as part of this, if someone does have a question, you'll notice on the bottom of your navigation bar for the Zoom video, you'll have the option of clicking on the Q&A tab if you wanted to submit a question during the program. Please do that anytime you'd like. We'll be getting to the questions throughout the program should someone have any specific items that they want some additional clarification and so on. So again, let's get started here. So right now, the basic idea is what is investing, and this concept gets a little confusing sometimes for individuals because investments can take on a couple of different areas. One, a lot of people think that investing is more like speculating, gambling on the volatility of certain assets and so on, hoping to obtain potentially higher returns and so on. So for example, if someone is trying to buy a particular stock and looking to time the market to make a quick profit, something like that. Others have a more longer term objective, like long-term savings and so on. Again, this is a more methodical objective, but in fact, overall investing is a little bit of both of those. And essentially the concept here is it's a carefully planned and prepared approach to managing and accumulating money. Now, again, investments take on many different flavors, and I like to categorize them like that because, like any individual, things are a little different in the investment world on each type of stock, bonds, mutual fund, whatever type of investment you're considering. So we're going to go into some of the details on that so you can have a better understanding of what this means for you. Now, one of the primary areas that we focus on with regards to investing is the impacts long-term with inflation. Realize an investment that you make over time typically has to outpace inflation. Inflation every year erodes the value of a dollar. So, in this chart that we're showing you right now, it's discussing the idea of saying, okay, someone has $200,000 today. If we have 3% inflation, which has been the national average since about 1914, what impact will that have over my dollars over time? So on this simple graph, we're going to show you here that after 20 years, if the $200,000 is not invested, it's earning zero. Considering 3% annual inflation, that $200,000 in 20 years is really only going to have the buying power of $108,000. So you can see how the value over 20 years has eroded for that $200,000 just by simply having inflation applied to it. So again, this idea that over time, it continues to erode. So over 40 years, that $200,000 only has a potential buying power of $59,000 after 40 years. So again, investing requires us to really look beyond inflation and understand the factors that can affect your accounts over time. And again, as we look at all this and consider all the various factors that go into an investment, you'll see the concept play out that time is really the most meaningful aspect of this. Now, the benefit of a long-term savings plan is really pretty straightforward. We have the effects of compounding interest, which really help enhance a portfolio's returns over time. And basically, as a simple concept here, let's say we were investing $5,000 annually, and we were assuming an interest rate or a growth rate of 6%. And all the earnings from the investment all get reinvested each year. So what essentially happens here is, as you go across the chart here on the lower level showing all the years that someone is investing, that simple $5,000 investment over the course of, in this case, 30 years at a 6% growth rate turns into a $400,000 account. So again, investing $5,000 annually at a 6% growth rate grows to $400,000. A lot of people, see this and they say, no, that can't make sense. But when you do the math, it works out. And we use a simple term here, drips make puddles. So over time, that investment starts to really grow and perform for you as things continue to move forward on the time horizon. Now, again, looking at this, again, that the end number here, the exact number at the end of the 30-year period is 395,000. This, in effect, is really where the rubber meets the road, so to speak, and provides an individual with the returns that are going to be necessary to outpace inflation, as we were discussing on the previous slide. I'm going to talk about this a little bit more in a second, but when you really look at this and consider the rule of 72, this has been a concept that's been around for years. And essentially, the rule of 72 means how long does it take to have my money double based on a specific either rate of return or the number of years. So in this case, if we took the rule of 72 and we divided it by 6%, that basically means that in 30 years, that every 12 years, that money will double. So that initial $5,000 will double in 12 years, and then the subsequent years investment and so on. So you can see how over time, this grows to the 395,000. Now, starting earlier in life, as we were talking before regarding the time horizon and the long-term objectives of a savings plan, putting off investing really is not the best option. If you can start earlier in life, I have clients that have 401k programs, and they have employees that range from the demographic from in their mid to late 20s up until people that are ready to retire. In this example, we're showing here that someone, when they are 20 years old, if they simply invested $3,000 annually at 6%, and again, assuming all earnings and so on are reinvested and there's no taxes taken out, again, this is a perfect example of how a 401k or a 403b plan works. That individual, after 45 years, will find that their money is going to be close to $700,000. Matter of fact, it grows up to $679,500 after that 45-year period. Conversely, if someone waited and decided to start their investments at age 35, giving them only 30 years to accumulate assets, investing the same $3,000 a year at 6% annual growth rate, the return on that investment will generate $254,000. Not bad, but it's definitely much less than the $679,000 that individual, when they were younger, started and really allowed that money to grow and compound with the interest. As we look here, we see here that someone that waited till their age 45, at 65, they only have $120,000. So the challenge for someone in these last two categories really is, A, are they able to do additional contributions to their accounts that would grow the money accordingly? If you look at this chart here, to get this person at 35 years old up to the same level that the 20-year-old has started at age 65, they would have to contribute approximately $7,500 a year versus $3,000 just to get close to that number of $679,000. The same goes for the person at 45 that is looking to get that $120,000 up to the same level as that 20-year-old. So again, that person is going to have to invest approximately 5 times the amount of money that that 20-year-old did. And again, providing that same amount of contribution over that 20-year period is going to be extremely critical for them to even get close to this number. So again, time is really of value to someone over the long run when it comes to investing. And again, experiencing the benefits of the compounding interest. Now, again, identifying the goals and time horizons that someone has is critical when you're planning for retirement, an educational savings fund, a special purchase like a home or a second home, or just in general having financial security. Goals can be long or short term. And in general, when you're looking at the longer time horizon, you're able to absorb more risks in the market. So you're able to really invest the portfolio a little bit more aggressively than someone that maybe has a shorter time horizon. And we're going to talk about all of that in a little bit when we start looking at the various options that are available to individuals to invest in. Now, one of the biggest factors that we try to discuss with individuals when we go into risk tolerance really comes from the idea of, having everyone as an individual can really feel differently about how they react to market conditions. And, the last decade has really shown us, how people react when it comes to market volatility and whether their investment plan has losses realized at various points. Realize if we're investing long-term and we're more aggressive, we're able to absorb and understand that the losses on a short-term basis are not going to be a negative impact long-term. But again, understanding that is really a matter of understanding that person's individual risk tolerance. We go through this conversation a lot with our clients, also many of the participants that we work with in retirement programs. And when talking about their personal risk tolerance, I could have two 40-year-old or two 30-year-old or two 50-year-olds sitting side by side. One could be conservative, one could be very aggressive. It's just the nature of who that person is and what's going to keep them up at night. The person that is more aggressive, as we were just talking about above this on the first bullet point, they're maybe understanding of if the market goes down a little bit at a various points or even has a big drop, they understand that their time horizon is much longer and they can absorb those losses. Conversely, that same 40-year-old, 50-year-old, or 30-year-old may feel a lot differently if they're in the wrong investment categories. For example, some people may ask a friend, hey, what do you think I should be investing in at my age? Oh, you should go into this. And then they turn around and the markets are going a little crazy and they see their position dropping in price and they're realizing a loss. That may keep them up at night. So it's a very emotional aspect to this. And, you really have to understand who you are as an investor. Now, as I was saying before, investors could come in a lot of flavors, aggressive, moderate, or conservative. Again, just understanding who you are as the investor will give you a much more satisfaction in your journey through the investment time horizon. Now, understanding risk is probably the biggest fundamental that we go through with someone, and understanding what the potential returns are for a given investment. And this is just a very simple chart here that shows the various levels of risk and potential returns of the various investments that are in the market. We're going to start here with treasury bills, which are short-term government bonds that have maturities generally less than 5 years. You'll see here that the risk factor is relatively low, but conversely, that potential return is also very low. And as we move up the scale here with CDs, government bonds, corporate bonds, preferred stocks, common stocks, options and futures, and I would probably add in there now cryptocurrencies, things along those lines. Those tend to be your more speculative areas. And as you can see, as we've moved up the line here, we see that the potential for returns are much greater with those particular investments. But conversely, the risk factors grow proportionately with those types of investments. So it's always a discussion about the trade-off between growth, stability, or income And again, measuring those objectives against an individual's risk tolerances, as well as what their overall goals and objectives and time horizons are for a particular type of account. Now, starting with the most basic type of investment, we have cash alternatives. This is like money markets, CDs, things along those lines. Next level would be the bonds, and these come in so many different flavors. We're going to get into that in a little detail later, but you could have government bonds, corporate bonds, obviously, various levels of treasuries or agency-backed bonds from the government. Again, those we'll talk about in a little bit. Stocks, these fall into a couple of different categories. There's common stock, which is probably the most generally purchased type of stock in the marketplace that represents direct ownership of a particular company. So for example, you could go out and buy a share of stock of Apple Computer. You are now a shareholder and a part owner of Apple Computer with that stock purchase. There's also preferred stock, which is sort of a hybrid between a stock and a bond, and it pays a specific interest rate. There's also preferential treatment if should the company that you're buying into does have some issues and they close their doors. And when it comes to paying off the investments, the bondholders would get paid first. Preferred stocks are the next level of reimbursement. And if there's any money left over, a common stockholder would realize the remains of whatever that investment was worth at the time. So a lot of things to talk about there. And then also we have other investments. Now, other investments cover a lot of ground here. This would be options, futures contracts, cryptocurrencies, things along those lines, which we'll touch on in a little bit. And lastly, we have funds. Now, mutual funds, for a little history lesson here, mutual funds was started in 1934. And they have grown over the decades. There's probably about 25 to 30,000 mutual funds right now registered and available for people to invest in the marketplace. There's also, over the last 20 years, the onset of what they call exchange traded funds, ETFs. These have become very popular and are quickly replacing mutual funds in the marketplace because they give more flexibility for an individual to buy and sell them throughout the day when the market is going through its ups or downs. So you can sell your investment at any point from 9:30 in the morning till 4 o'clock in the afternoon based on New York time, where in a mutual fund, you cannot sell it until the end of the day. Now, this sometimes is a concern for individuals that are maybe trying to time the markets. And, they wake up in the morning, they put on the TV and they see all sorts of stuff going on geopolitically or with the economy or in general, just the stock markets. And they decide, oh my God, I got to get out of my account. And I have all my mutual funds tied up in these investments. If you put in sell orders at 10 o'clock that day, the sell order will not be exercised for a mutual fund until 4 p.m. So if that particular investment goes through a decline throughout the day, you will get the closing price at the end of the day. A lot of people would like to have more control over that. ETFs trade like a stock throughout the day. So at 10 a.m., if you entered a sell order, that sell order gets exercised and you buy and you're out of that investment at that time. Conversely, if you wanted to buy into the market, it works exactly the same way. You want to buy an ETF, an exchange traded fund, anytime between 9:30 and 4, you will buy it at that specific time you enter the order. Conversely, if you are going to be buying a mutual fund, you will get the price of the closing value of that fund at the end of the day. So some things to consider here. 401k plans and IRAs and 403bs are not investments. And I try to counsel people on this all the time. They're basically investment vehicles that have tax advantage benefits to them. Realize inside of a 401k or an IRA or 403b, this is where the investments really are. All a 401k means or an IRA is that it's a certain type of account that you're utilizing to hold your investments. And these obviously have the advantages that you don't pay taxes on them until after retirement. Roth IRAs, obviously, you're putting money in that's after-tax money, and it would basically be a tax-free withdrawal at that point when you are retired. So just the general understanding of the titling of an account versus what the actual investment is within the account. And these are important factors when you want to discuss these and so on. Now, focusing on the lower risk categories here, cash alternatives. Again, they offer low risk, they're short term, and they're relatively liquid. Examples of alternatives, include, CDs. You can buy a CD at pretty much any bank out there. They have a specific maturity time, and you will earn interest over that timeline. If you did need to sell or break out of a CD before its maturity, you potentially would lose some or all of the interest that was accumulating within that CD. So it's important to understand, if you do need liquidity in your account, a CD may not be the best option. A money market, those tend to be more popular within the banking world for earning basic interest. Again, the interest rates that money markets in general pay is relatively low. The average out there right now is anywhere from 0.10% up to 0.5% or 0.5%. So you can see there, you're not getting very far with these types of investments, but they are very safe and they're liquid. A lot of times with the money markets, they can have a checkbook tied to them and you can access the funds right away or transfer them into your regular checking account. So a lot of the banks with their online services will give you that flexibility. Some of the other options that are out there are the US Treasury bills. Again, these are short-term savings that basically have maturities below 5 years that are issued by the US government. Again, the value of these types of bills or bonds in general will vary from when you purchase them initially to when they mature. So if you have a bond, let's say, or a treasury bill that matures in 2 years, from the date that you purchased it to the date it matures, depending on what's going on out in the marketplace with regards to interest rates, the value of that bond may go up or down depending on where interest rates are relative to when you purchased it. So for example, if when you purchased it, the bond was valued here and this was the interest rate, if interest rates go up, the value of the bond will go down. And conversely, if interest rates go down, the value of the bond will go up, to adjust for the differences in the yield at various times until maturity. These types of situations can be concerning for people when they are looking for liquidity. Generally, if you are committed to letting it go to maturity, you will not have a problem. You'll collect all your interest payments along the way until that bond matures, and you'll get your original principal back as well as the interest that was credited during that period. Now, as we move forward here, some of the advantages of these type of cash alternatives, the earnings are very predictable. You know what the interest rate is going to be, you know what it's going to be paying over the course of time. They're highly liquid. Again, you can buy or sell the US Treasuries at any time, or you can access the money markets or in general a CD if you went to break out of it relatively quickly, and you can get at your cash. And again, in most cases, with regards to bank CDs, money market accounts, things like that, they are FDIC insured because they are part of your banking. So there's very little risk to principal in that regard. And also with US Treasuries, you're getting the backing of the US government with their full faith and credit. The disadvantages, as we're seeing here, is they have relatively low returns. So, and as we were talking before about inflation, if inflation is maintaining an average of about 3% over time, you can see that having an investment that's only returning maybe 0.5% to 1%, 2% is not going to keep your dollars at pace with inflation. And therefore that investment or that portion of your investment account may over time have an eroding value when it comes to its purchasing power. Now, the next category up is bonds in general. Now, bonds basically are loans. They're a generic term But at the end of the day, when you buy a bond, whether it's at a bank, you buy a US government EE bond, or you're buying a general treasury bond or an agency bond or a corporate bond, you are loaning money to that entity, whether it be the bank, the corporation, the government, and so on, and they are going to pay you a fixed interest rate. When you look at this, they're paid at regular intervals as far as the interest, and these are paid out to you in most cases. Some bonds will reinvest those dollars depending on the type of bond, like in a government EE saving bond. The interest accrues in the bond over time, so its value will appreciate over that timeline. But typically a bond, a corporate bond or a treasury will pay out interest based on either a monthly, quarterly, or semi-annual basis. And each bond will identify this if you are purchasing one. And again, they can be traded like any other security. You can go into a brokerage account and openly buy or sell a bond at any time. There's always a very active market for that. But like I was saying before, the values of these bonds will fluctuate over time, depending up until maturity, depending again on what's going on in the interest rate market. So those are some of the main concerns there. And again, just going at the types of bonds here, US government securities, you have agency bonds, municipal bonds, which sometimes offer triple tax-free returns on the interest that you're getting paid, and then again, corporate bonds and so on. Now, again, just understanding bonds in general, the advantages, they have a steady and predictable income stream. They typically would have a higher than cash alternative return as far as the income that they generate. And they tend to be lower risk compared to other investment options like stocks and things along those lines. And what I like about bonds particularly is they're a tremendous diversifier within a portfolio because they have a very low correlation to stocks. And what I mean by that is typically when we have a portfolio, we'll diversify a client with a mix of both stocks and bonds, depending on the types of securities and time horizon and risk tolerance they have. But when the stock markets go through their cycles, which we know they go up and down, and cycles occur every 5-6 years, we'll have growth or what they call expansionary periods. And then we have contracting periods when the markets maybe pull back and reevaluate the valuations and so on based on either economic or geopolitical conditions, things along those lines. We've gone through a very odd phase over the last couple of years with this pandemic that's played out and how that's directly impacted the economy. So by having bonds, though, in the portfolio, they diversify the account. So maybe the stocks, if they go down, the bond side will appreciate. Now, it's not a one-to-one ratio, and people have to understand that, but the correlation or a lack of correlation really does help balance out the portfolio over time. Now, there are disadvantages. Obviously, when you're loaning money to a corporation and you're buying their bonds, loaning them that $1,000 face amount that the bond is, you're paying for it, and it's paying an interest rate, maybe it's 4%, 5%, whatever it is. Like in an individual, corporations have risk scores, just like you have a credit score. So there's always the potential for a default. That's why sometimes you'll hear how people categorize bonds. You'll see them rated as AAA, which is the absolute best. That would be a treasury bond. Then you go AA, which would maybe be a government agency bond. Then there's A, triple B, B, and so on. And they go down all the way down to D. And essentially, the higher the rating of the bond, the lower the return would be because there's a lower risk. But conversely, if you have a bond that essentially has a higher risk profile or a lower credit score, you will see that bond paying conversely a higher return. So this is sort of that seesaw effect that I was talking about before. Same idea, though, with the credit score. The basic idea here that you can translate to you individually, if you were a person looking to buy a home and you had a low credit score, if you go to apply for a mortgage, you're likely going to pay a higher interest rate on that mortgage versus if you were someone with a high credit score, you would potentially have you would be a lower risk to that bank, so they would charge you a lower interest rate. Same basic concept there with bonds. And again, talking about how bonds will fluctuate throughout its life until it matures, the values will always be dictated by the market conditions, the rating of the bond, and again, where interest rates are at any given time. But in general, the lower risk profile of a bond means potentially lower returns. Again, comparing this to a stock investment. So just having that understanding that bonds tend to be more conservative in nature is generally the takeaway that you should have from this part of the conversation. Now, looking at stocks, again, the basic concept here, as I mentioned earlier, they represent your ownership position in a particular business or company. The percentage of ownership is determined by the number of shares you own and also the profitability or if a company shows losses. So just understanding those relationships in a particular investment with a stock. Again, you're an owner of that particular company, and your ownership is determined by the value of the shares. And again, the profit and loss of that particular investment that you've made. Again, earnings within a company may be distributed when you own the stock, either as a dividend, or you may be realizing some gains or losses when the stock is sold. So again, understanding these risk profiles to these particular investments is critical. Within stocks, there's a couple of different types of ownership that you can realize. You have common stocks, as we talked about before, and then there's preferred stocks. And these, again, are categorized more as a hybrid between a bond and a common stock, in the idea that a preferred stock pays an interest or a dividend payment that's fixed versus a common stock, which can vary over time. And these all come into various categories. You have small companies, mid-size, and large. In the marketplace, they refer to these as small cap, mid cap, and large cap. In general terminology, stocks can be also categorized into growth stocks. These would tend to be your technology type companies. Value stocks, which are more like your staple good providers. These could be food producers, energy companies, utilities, things along those lines. Some could be industrial type stocks that pay a very high dividend, which provide income. Blue chip is also a generic term that a lot of people utilize, again, to identify, let's say, the top rated largest companies out there. The S&P 500 is 500 various growth and value stocks that are mixed into an index. A lot of those stocks are considered blue chip by their category. And then we have what's called ADRs, or American Depository Receipts. These are the ways that an individual can buy foreign stocks, but through a US stock exchange. Companies will go out there, and let's say you wanted to buy a Japanese company or a European company, but their stock doesn't actively trade on the US exchanges. An investment firm would come out and create an American Depository Receipt, or an ADR, which basically converts that particular security from the foreign market into US currency. So it's in US dollars that you can buy those shares. There are some advantages to these options, but today, given the technological advances that we've been seeing across the world with regards to how the stock markets operate and the trading platforms out there, you could today go on a platform and trade 24 hours a day if you really wanted to buy and sell various stocks or bonds, and buy from all various exchanges around the world. The technology is there, and we're seeing this happening today. It's not readily available to the average investor. And frankly, the average investor most likely would not be able to benefit from this, because you do have to be very actively involved in this. Now, talking about stocks in general, again, the advantages of these, historically, they've provided the highest long-term total returns. When I say that the average returns on stocks have in general been better, the long-term return within the stock market, when you consider, let's say, just the S&P 500 or the various other indexes, you're averaging probably long-term 7, 8, or 9%, depending on what year you're in and things like that. Versus a bond type portfolio, which typically would return somewhere in the range long-term, depending on the type of bond, treasury or corporate or municipal, things like that, but generally between 1 to maybe 3%, 4%. So you can see how stocks can provide a much higher potential return over the long term. In addition, you have ownership rights. So when you own common stock in a company, you would get the opportunity to vote on certain issues that are affecting the companies. You can vote for the board of directors, and you can have a say in what goes on in the company to some extent. And also they are required to communicate with you via their filings. And you may see that, companies are posting their filings every quarter. These are called the 10Q reports. You can pull these up. They're available in the market. But the idea is that you as an owner of that stock would have access to all of this information as well as the general public, and would have the opportunity again to communicate to management if they like or don't like what's going on in the company. And you may have heard terms like activist investors, things like that, that are pushing boards to create more opportunity for growth within a firm. And sometimes those activist investors may force the sale of certain assets, things along those lines. A perfect example of this is the story for General Electric. GE over the last decade has gone through a lot of changes. They were a stalwart industrial type stock that was in everything from financial services to jet engine manufacturing and everything in between. As the economy has changed, these types of industrial companies have also changed. And if they didn't adapt to the new market conditions that were out there, you had activist investors coming in, which they did in the case of GE, and said, listen, we need to change the management. The stock is not doing well. We need to either divest or sell off some of these divisions that are not profitable, which they did. And they refocused their energies towards the industrial production of jet engines and the like. GE has started to recover from that. But over that time period, the stock dropped down. Again, they sold some of these divisions. They had to prop up their dividend. So as an owner, you have a say in what goes on in that company. And that's a perfect example of how you can participate in the management of the company. Again, it's an opportunity, and everyone has that as a common stock owner. Lastly, you can provide income through dividends as well as capital appreciation. So if a stock goes from $10 to 15 or 20, if you sell that stock, you can realize those gains. Or if you're still holding the stock, companies will pay on average, if they're a dividend payer, marketplace, the S&P 500, average of about 2 to 3% in dividends each year. Some are much higher, some can be lower. So again, depending on the company and the stock, again, you would have to look at these when you're purchasing it and doing your research into that particular company. And the other benefit and advantage here is they're easy to buy and sell. You can go online and buy and sell stocks all day long. There's apps for your phone, things along those lines. So again, if someone is interested in doing that kind of trading and having the ability to manage a portfolio, utilizing stocks over the long term can be beneficial. But again, if you're buying individual securities, you really have to pay attention to what's going on with that particular account and that security and company, and just understand, where your gains and losses are coming from, and pick a definite gain profitability margin. So for example, if you're buying a stock at $20 and you're saying to yourself, I think if this stock hits, $30, I'm going to sell it. Frequently, we see people that will try to say, oh, it went to $30, it's going to 40 next. Don't get greedy. Sell the stock. If $30 was your target price, sell it and move on to something else or reinvest in the company. But don't just think that it's just going to continue to ride, because a lot of people get caught up in that. And again, if they're not monitoring this and paying attention to what's going in the market, they'll ride the stock up and they'll ride it back down because they become emotionally attached to it. That is something that you have to avoid. You have to be very disciplined. At the same time, when a stock is going down, set a loss target that I will not lose any more than this if this stock goes below this particular price. So in my example before, if I bought a $20 stock, if I see the market starting to come down on that stock, I'm going to pick a target and say, okay, if that stock hits $17, I'm going to sell it because I'm not going to follow it down. You may see a trading range on a particular stock, and that's fine, but understand setting goals for the gain that you want to realize or the loss that you don't want to go beyond is critical in this particular situation. So again, they're easy to buy and sell, but understand why you're buying and selling a particular stock at any given time. Now, the disadvantages, again, poor company performance affects the dividends or the values of the shares. Again, as I was just discussing the GE example, we had poor performance in the company. The dividend was at risk. GE was always a tremendous dividend payer over the decades. And many pension plans owned GE in their portfolios, as well as a lot of older individuals that were depending on that dividend income. They had to sell a lot of their other assets to continue that dividend stream under GE. And again, the value of the shares will reflect the company's performance. So if a stock is dropping in value, it is likely that it is because there's some performance internally that is affecting it, or the market in general does not look upon the stock as a favorable option. Again, subject to volatility. If anything has taught us over the last 20 years with the stock market, let alone the last 100 years, stocks will go up and down. They tend to be more volatile depending on what part of the investment or market cycles we're in. So it's important to understand this when you are setting profit or loss parameters for a particular investment. Market conditions could change rapidly. So just be aware of volatility is probably one of the items here that a lot of people don't consider when it comes to a stock's performance. So it's a tremendous understanding of that will help you over the timeline. And again, greater risk to principal versus a bond. A bond will always have an inherent value, but a stock will fluctuate in value day to day much more. And so understanding that risk factor of that particular stock is important here. And in general, the short-term nature of trading, if someone is looking for short-term quick gains, stocks may not be the most appropriate unless, again, you're watching it very closely. We come across a lot of people that, see the stock market going up. They're talking to all of their friends. And, when we start to see the market hitting a high, we start to get the phone calls, I got to get in. These are people that maybe sometimes were sitting on the sidelines with cash, and they're just seeing everyone starting to make money in a particular security, whether it's a stock or bond or even a cryptocurrency, something like that. And they want to get in, and they typically want to get in when it's towards the top. Understand that for short-term trading purposes, this sometimes is the worst time to get into these particular stocks because of the short-term trading that occurs in various securities. Realize you're out there taking a position, buying or selling a particular stock at various points when the market may be going through a volatile cycle. So understanding the short-term trading aspects of a particular stock is very important. Now, again, looking at the other investment categories, real estate over the last couple of years with regards to what happened during the pandemic has been really performing quite well if you're looking at the residential real estate market. Conversely, though, if you look at what's been going on in the commercial market, particularly with retail, with the onset of all of the various online shopping programs that are out there, and Amazon is the first one that comes to mind for most people, you've seen a tremendous shift from people going to brick and mortar stores to ordering the majority of their needs online. So think about companies that own big shopping malls, things along those lines. you're seeing a lot of those getting closed or being repurposed into other types of entities. We're going through this shift at the moment, and it's going to be interesting to see how this plays out over the next 5 years. So even within a specific category like real estate, you have commercial, you have residential. Commercial is having its issues right now because of the pandemic. A lot of people were working from home, so they're not going to these big office buildings in the cities and so on. And so the need for office space has been declining. Retail space has been declining because of online shopping. So again, these categories are out there. Just understand what they are and where you can access these types of investments. Typically, individual investors would look at real estate investment trusts. These have been very popular for this purpose, and you can buy them into the various categories, and they can be very specific into a residential type program that maybe has multi-unit housing as part of its particular component of the portfolio, or again, commercial properties, things along those lines. So understanding the types of investments that are available in each of these other categories is important. Stock options. This is pure speculation on whether a stock is going up or down. Realize people buy and sell options all day long in order to sometimes hedge a portfolio or leverage a portfolio if they own a particular stock or they like a particular industry. So that is pure speculation, and a stock option typically matures within 30 or 60 days, depending on the type of option it is. Sometimes it's a shorter time horizon. The idea with a stock option, though, is you can leverage your money and receive multiples of your returns by utilizing these strategies. But realize in a lot of cases, it's pure speculation. Then we go into futures and commodities. Commodities generally is anything that we consume. When you think of oil, gas, lumber, things along those lines. But then you also get into the precious metals like gold, silver, and platinum, and so on. Realize you can buy futures on the prices of these commodities. It's the same idea as a stock option. You can project, hey, I think gold is going up, or I think gold is going down. Same story with lumber or oil, things along those lines. Over the last year, we saw oil prices rising up quite a bit. And again, just looking at what the conditions are in the marketplace, some people feel oil may go a little higher or could go lower. So people are placing bets with future contracts on either scenario. So again, something to consider. It's not for most people, but again, it is an option that's out there as far as the investable universe. And lastly, there has been a lot of speculation over the last couple of decades in the collectibles arena. And what I mean by that is you can buy artwork, and it is a collectible item. We normally would see, pieces of high quality artwork appreciating over time and, providing a decent return if someone sells it. But this is probably the most speculative of these areas, even though you own a hard asset like a piece of artwork. And, maybe it's a Van Gogh, something like that. There are portfolios that invest in these types of things. But again, it's a very speculative area because it's only worth what someone at a given time is wanting to purchase it for. So the marketplace is not as liquid as the other categories that we were just talking about. So again, just a consideration there when you start to think about other investment options that are available in the marketplace. Now, I mentioned earlier about mutual funds and exchange traded funds, and we're going to touch on those right now. Now, when you look at the benefits of a mutual fund in general, your money is pooled with other investors. So the idea is that when you buy into a mutual fund, there's thousands of other investors that are also putting their money together with you. Inside of that mutual fund, we typically see between 100 to maybe 300 different types of securities that are part of the portfolio. And that could be either stocks, bonds, REITs, things along those lines. Then you own a portion of that portfolio. So if you have a small amount of money that you're looking to invest, a mutual fund is a nice option to consider because If you buy one share of a particular mutual fund, you're going to get a portion of 100 to 300, let's say, other types of securities in the mix. So if, for example, we have a mutual fund that invests in the S&P 500, which represents an index of 500 of the largest companies in the United States. If you buy one share of that mutual fund, let's say it's $50, you now own a piece of a portfolio that has 500 different stocks in it. Same thing could be with a bond portfolio. You can buy a mutual fund that just invests in bonds. And again, you can have 100 different bonds that you now own a piece of. That's the benefits of a mutual fund. It provides instant diversification inside that particular pool of investments with the other investors that you're partnered with in there. Now, again, considering all the factors, and this is just a basic disclosure, whenever you're investing in a particular mutual fund, you should always read the prospectus and understand the investment objective of the funds, the risks, charges, and expenses, because there are expenses that the manager of that particular fund charges as part of their management expertise to provide potentially better returns than the market, which is why you would buy a mutual fund. But if you're buying a index fund, for example, that just invests, like I showed in the example before, the S&P 500, there's really not much to manage because that manager just has to maintain that portfolio of 500 different stocks. But if I have a manager that says, I am going to specialize in investing in large cap technology companies, understand that they are going to be buying and selling those particular shares throughout the year. And again, the expenses in that particular mutual fund may be higher because of this. So understanding all of this is important before you invest in any shares of a mutual fund. Now, again, the three major categories of mutual funds out there, we have money market type funds, we have bond funds, we have stock funds, and then we have a hybrid category called balance funds. We utilize these a lot with various clients for the simple reason that they are a blend of both stocks and bonds. Realize when someone is older and closer or in retirement, you would typically have a lot less stock in your portfolio and a lot higher level of holdings in bonds. Conversely, if you're younger and have a higher risk tolerance, you would have a balanced fund that particularly would have a much greater weighting of stocks in the portfolio. And maybe it's 75% or 80%, and the remaining 20% was in bonds. Again, depending on the situation, there's balanced funds out there that can be dialed into any particular objective. They could be international, they could be domestic, they could be large cap, mid cap, small cap. But again, understanding the blend of what the ratio is to stocks to bonds in these is very important. And again, the various risk factors that go with the particular type of investment. Now, when we start again looking at the international funds, that obviously brings us up into a much higher potential return category, but also a much higher risk. So again, the balanced portfolios will take advantage of these particular mixes of securities to provide the proper diversification. And again, some of them may be active or passive. Again, active management, as I was saying before, someone that's specializing in a specific category of funds, of stocks, versus a passive investment, which would typically be an index portfolio like the S&P 500. Now, the general disadvantages and advantages of a particular mutual fund. Again, we talked about the advantages of diversification. There's professional management. You can invest a small amount of money in the particular fund. And again, you have liquidity. Again, the funds trade at the end of the day. You can get out of them at any time or buy into them at the closing price every day. The disadvantage is that during the day, the shares can fluctuate in value. a portion of the fund's dollars may be tied up in some cash or for liquidity needs and so on. So it may not be as pure an investment in a particular category that you may want or need. Potential tax inefficiencies, and this has come up periodically when people discuss what's called phantom income. So if you own a mutual fund that's not inside a retirement account, where it would have a tax deferred or tax-free growth profile. So during the year, as I was explaining before with active management, if a manager is buying and selling stocks, and let's just use an example, they bought a particular stock at $10 a share, and they sold that particular stock later on in the year for $15. So they realized a $5 capital gain that they took into the fund and then reinvested it into more shares of other types of stocks or bonds in the portfolio. What happens is at the end of the year, an investor will get a 1099 from that fund, and it'll show the potential gains in the fund that were realized during the year, and you'll pay taxes on that, but you never personally received a check of those gains. Instead, they were being reinvested. So this is sometimes a disadvantage with the world of mutual funds, in that some of them will have these phantom income realizations throughout the year that you as the investor don't physically see that money, but you have to pay taxes on. It happens. There are funds out there, though, that specialize in being tax efficient. So again, understanding the fund, the objective, and again, the risk profile is extremely important. Now, when it comes to the fees and expenses within a fund, as I was talking about before, professional management versus a passive management situation, when we start to look at what a passive situation is, which is really an index model, we see the fees on that particular fund at a very low level. Best example I can give you is one of the leaders in the marketplace is Vanguard in the indexing world. You can buy an indexed S&P 500 mutual fund that would have an expense ratio of maybe 0.05%, very low. Conversely, an actively managed fund can have fees in upwards of 0.75% to 1% or more. International funds have a much higher expense ratio, typically because they're trading on international markets, and sometimes there's additional costs that they realize when it comes to currency conversions, things like that. So again, just understanding the fees and expenses within a fund is critical, and the investment objective. If a manager of a fund is highly rated and their management expertise puts them in the top quartile of performance amongst their peers, it may be worthwhile to pay that manager that additional expense in the fund. So again, just understanding what their potential returns have been, and the, again, tax efficiency within the portfolio, and again, their overall gains and returns over time are really what's going to determine whether it's worthwhile or not to pay those additional expenses. If you're looking for something just to be more passive and track with the indexes, buy the index mutual fund and you'll pay a very low expense ratio. And again, you'll track with the market versus a manager that would basically potentially provide additional gains in the portfolio. Now, the other options that are out there, as I mentioned before, are these exchange traded funds, or ETFs. Now, something to understand here, most ETFs out there are based on an index. One thing that has come out, though, the indexes that are available out in the marketplace now are so diverse. I can buy an ETF that specializes in an index that tracks the performance of a basket of stocks that are in the solar energy industry, or water producing, or manufacturing, things along those lines, or simply a bond portfolio that tracks with the aggregate bond index or treasury index. There's so many different options. You can buy an ETF that's specific to one country and that particular country's index. Obviously, you can buy the S&P 500, the Dow Jones, the NASDAQ. You can buy a mix of the Russell 2000. There's so many of them available out there. I think every year now over the last decade, there's been thousands of ETFs added to the investment world, and they keep coming out with newer options. A lot of the new trends are managed ETFs, where you have a manager potentially creating their investment strategy within an ETF that you can buy and sell throughout the day like a stock. So there are some definite advantages to them. Again, passive management have lower fund costs. Again, if we're just tracking an index, again, the fund cost would be very low, just like it was with a mutual fund. But if it was an actively managed portfolio, the expenses could be higher. Again, you can trade them throughout the day. They can be bought on margined or shorted like stocks. Again, these are strategies that, if you're not familiar with them, we can talk offline at any time if you want to give me a call, and I can explain to you how margin works. Again, basically, it is you're leveraging the asset to buy more, so you have a potential either higher gain. This is typically with a margin position on a particular ETF or a stock, or shorted. You think that position is going to go down. Again, you can speculate in these categories all day long. Again, understanding your risk factors is tremendous. One of the benefits of an ETF, though, is they may provide tax efficiencies. Unlike a mutual fund, you will not get that phantom income that you realized in most cases. Some of them may have it. And again, understanding the particular ETF that you're looking to purchase, reading through the prospectus and understanding the investment categories is critical here. Okay. And again, just going through that again on a disclosure basis, making sure that you consider all of the investment objectives of the ETF, the risk factors, the charges, expenses, all of this is available in the prospectus for that particular ETF. So make sure you understand it, read it carefully, and so on. Now, there's a strategy that has been around for decades called dollar cost averaging. And this is typically how a 401k or a 403b plan works, in that you have money going in every month into a particular account. It's usually the same dollar amount. And the advantages of dollar cost averaging are tremendous. I particularly recommend this to a lot of clients because they may come to me with $100,000, $200,000, $300,000 and say, okay, I want to put this to work in the marketplace. And if the market is going through some ups and downs over the course of the prior period, we may say, why don't we spread out your entry points into this particular investment? So by investing the same dollar amount over regular intervals, in this case, in the example we're going to talk about is monthly, over time, what happens is your average cost per share potentially is lower. And when I start to talk about this, let's look at the example here of someone that was investing $300 a month for over the course of a 5-month period. Now, let's say in January, that individual was investing $300 in a particular security, whether it's an ETF, mutual fund, whatever it is. And at that time, the share price of that stock, ETF, or mutual fund was $30 per share. At that time, they purchased 10 shares. But something happened in the marketplace, and that following month, the share price of that particular stock, bond, mutual fund, ETF dropped down to $10 per share. That $300 went into the account again to buy the shares, but this time, because the stock price was lower, they're buying 30 shares. And then the following month, the share price goes up to $20 a share, so they buy 15 shares. And then when we go out to April, the share price dropped back down to around 15 from 20, so they bought 20 shares. And then later on in May, the share price was up to $25 a share, so they bought 12 shares at that time. If you just do the average market price of those shares, you end up with $20 is the average price. But the average cost per share, when you dollar cost average, again, considering that over that 5 months, we invested $1,500, we had bought 87 shares, the share price is actually average $17.24. So you can see here over time, utilizing a dollar cost averaging strategy, can potentially bring you into lowering your entry point risk of when you buy the shares of a particular company, mutual fund, or ETF, and B, provide you with the benefit of having a lower average cost per share. This is a tremendous option, and I recommend to most people to follow this. It reduces a lot of the risk that's in a portfolio. It's the old story. People loved the stock when they were buying it at $30. They're buying it again at $10, so it's like it's on sale with the market. And then again, as the price changes month to month, they're buying additional shares at that fixed dollar amount each month. So again, averaging them into the market is probably the best strategy for reducing that risk factor. One of the biggest areas that we focus on with most of our clients is asset allocation. And this is really discussing the overall diversification of a portfolio, the risk tolerance of the individual investor, the time frames involved with the particular investment, whether it's long, short, or moderate term, what their personal finances are, and also their needs for liquidity. All of these factors are a tremendous consideration when we design a portfolio. And as an example here, this is what a conservative portfolio would typically look like. We would have an allocation to bonds. As we discussed earlier, bonds tend to be a more conservative type investment. They pay a fixed interest rate, and they're relatively predictable as far as what the earnings would be within that portfolio based on the interest rate that's being paid. Then we would have cash alternatives. So again, CDs, short-term treasuries, things along those lines. And again, that would be about 25%. Then we would allocate about 25% into stock. And these may be your more high quality stocks, less speculative, things along those lines. So we may buy the Dow Jones, the utilities, food producers, pharmaceutical companies that are not going to be a huge surprise if they go crazy up or crazy down. We know what their earnings are. We know what the dividends that they're paying. So it tends to fall into a more conservative category within the stock world. So when you look at this type of portfolio, this type of an account may return long-term around 6%, somewhere in those lines, 7%. We've had some that have done much better depending on what's going on in the market in a given year. But the idea is, again, looking at the categories and what the risk tolerance is of that particular investor and their time horizons. That's really what determines the final ratios that we create for the portfolio. The next level would be as a moderate investor. Now, in this situation, we have about 50% of the portfolio invested in stock. Then the remaining 50% would be in a bond mix of about 40%, and maybe 10% in the cash alternatives. Again, this will balance out over time. This is what we use as a baseline for our balanced models. If we have someone that's younger but wants to be balanced, they may have a higher allocation to stock versus bonds and so on. So again, understanding that desire for predictability of income and potential growth really factor into how we balance out a portfolio under a moderate risk situation. When we start to get into the aggressive models, this is where we start to see a higher risk profile for that particular investor. If we're allocating 75 or more % to stocks, that automatically puts us into a more aggressive category. Now, within this stock mix, we can have international, we can have domestic US stocks, we'll have potentially very conservative stocks like we were discussing before, like Dow Jones, industrials, pharmaceuticals, food producers, and so on. So again, this type of portfolio would run the gamut, but it would probably have a more heavy weighting towards technology as a growth factor, because this particular investor may have a very high risk tolerance. So they can absorb the volatility that would occur in a portfolio like this based on their particular profile. Conversely, we would also have a smaller allocation to bonds and the cash alternatives. And again, depending on that individual, We have clients that we have aggressive portfolios that go 100% stock. We tend to back off of that a little bit in most cases and balance it out to have a little bit of cash or cash alternatives or some bonds in the mix. Maybe it's 90%, maybe it goes down to 80% or 75. But just again, having an understanding of what components make up the portfolio and what risk profile that particular portfolio will be providing is critical when you're understanding this particular type of program. Now, again, a financial professional, again, helps you determine your investment goals, your timelines, and risk tolerance. We create these investment models, selecting the investments and monitoring the portfolio and making changes as necessary. So again, understanding the client is probably one of our biggest objectives. We go through an extensive interview process, understanding the objectives of that individual, what their risk tolerances are, their experience with investing in the past, and again, the overall goals and objectives for the account. It's not something that's just you set it and forget it. As I was saying before, if you are going to be active in managing your own portfolios with stocks or bonds, you really have to pay attention to what's going on in a lot of cases day to day, because we've seen just over the last 6 months, we've seen various days where the market will fluctuate 2, 3%, sometimes 5% on a particular category of stocks. So again, understanding those goals and objectives of what is your target price for gains or growth, and conversely, if there's a downside potential risk, you want to understand where your stop loss is at so you don't go beyond that. So that's something that we do for our clients, and we've been doing this for over 30 plus years. So if you do have questions about your own individual accounts, please reach out to us. We're more than happy to help you through any of this and your journey through life. And again, I just want to thank everybody. We're under unusual times here. I usually love to do these presentations in person, but through Zoom and technology, we have the ability to meet virtually. And I thank you all, and I wish you all the best in 2022. And happy investing. Take care. Take care, everyone.